Hello guys and welcome to Daily Market Movements. Welcome to another episode of Indices Watch. In today's video, as always, we're going to be analysing the S&P 500 and the NASDAQ100 price chart. Rather volatile day to start off the trading week. We had both the NASDAQ100 and the S&P rally into the open, and then shortly after we actually saw a turnaround and both indices ended in the negative. We had the S&P 500 pull back roughly 0.8% and the NASDAQ as well. And you may be asking, why did this happen? And that was because Joe Biden announced that Jerome Powell will have another term in the Fed as the Fed chairman. So Jerome Powell, who is he? Well, as I just mentioned, he is the Fed chairman, but he is the one who decides whether interest rates are cut, hiked, whether money should be injected into the financial markets. And as of recent, since those March sell-offs that occurred all the way in 2020 when COVID first hit us, Jerome Powell announced that the Fed will be injecting $120 billion into the financial markets, and interest rates have been cut to an all-time low, near enough 0%. So Jerome Powell has been extremely bullish for the markets, as the chart will tell you. You know, we've rallied an incredible 150% here in the NASDAQ 100 in 18 months, which is just unheard of. You only have to zoom out really on the daily to understand how steep of a climb we have had. In fact, let me go on to the weekly chart, the monthly chart, just to show you how steep we have climbed. You know, if I just take away that percentage, there you go. You know, we've been grinding towards the upside rather nicely over the past couple of decades, but these past 18 months, it's just incredible how much we have gained. But with Jerome Powell now being the Fed chairman for the next term, the traders actually kind of saw this as a little bit bearish, and the reason being is because Jerome Powell recently announced that they will begin to taper the $120 billion that they're currently committing to the financial markets on a monthly basis by $15 billion starting next month. So we are approaching the end of November, so that means that the tapering process will begin in about 2 weeks' time. And as well as that, once Joe Biden announced that, the yields, the bond yields, which are typically used to kind of predict when interest rates are expected to be hiked, they actually showed a change in direction. And now there's a 50% chance that interest rates could be hiked as early as May 2022, which makes it very interesting because this is something I made very clear just about 3 or 4 episodes ago. I said that I personally think that interest rates will start to get hiked mid-2022, whilst the dot chart currently suggests that interest rates are expected to be hiked at the beginning of 2023. So all of a sudden, after Joe Biden's announcement yesterday, that interest rate expectation for that first hike has moved forward by roughly 6 to 9 months, which of course is not good for the stock market. The stock market thrives in an environment where interest rates are at an all-time low because they have to pay less interest. And once those interest rates get hiked, investors take a step back, they recalculate the cash flows, etc., the future cash flows of these companies, and of course their profits, their net profits are a lot lower. This is economics 2.0 when it comes to interest rates. So NASDAQ 100 is currently up at 16,300. The S&P 500 is currently at 4,662. And the reason that I've come onto YouTube today is to basically let all of the new traders here, all of the new retail traders, perhaps you've been trading in the past 18 months, and it's basically to let you know, my personal opinion on the markets right now is to not open any trades whatsoever. Don't try and short the market because it's obviously in a fantastic uptrend at this moment in time. But at the same time, we are pretty much overbought. We're just coming off that 70 level on both RSIs. As you can see, the NASDAQ 100 is currently down at 61, but we were overbought just a few sessions ago. And the S&P 500 is down at 60, but again, we were overbought just a few sessions ago. And, I'm going to come on here and advise you all not to open a trade. Of course, this isn't financial advice. This is just my own opinion. You should do your own research before entering or not entering the market. But my personal opinion is, right now, it is not worth an investment in either market. If we went up to 4,800, which is many investors' end of the year target, and of course we only have a month left of the year, that would represent a 2.93% move towards the upside. But the 50-day EMA, which could be an easy target towards the downside if we were to fall for some reason, and there's plenty of reasons out there as to why we could potentially fall, that also represents a 2.5% move towards the downside. So that gives a 1-for-1 risk-reward ratio. And I just mentioned here in the S&P 500 a few moments ago that in the past 18 months we have rallied an astonishing 116% towards the upside. Okay, if let's say for some reason the S&P 500 fell to the 200-day EMA, which is all the way down at 4,258, so let's just see that from a percentage perspective, that would represent a 8.27% move lower. That wouldn't even be considered as a correction. You know, a correction is typically after 10%. You know, if we fell to that 200-day EMA all the way down at 4,270, investors would look at that and pretty much say, well, that's fair enough. You know, we've rallied 116% and we've just had a 8% correction. So what I'm trying to you know, share with you all here is that if you are a new to trading and you're trading on a leveraged account, or you've got an account balance which is under $10,000, don't be going to buy the tops around these areas here. It's not worth it. You know, if you work the math, simple percentage points, it's just not worth the risk. And you know, hopefully I could just help one trader who's watching my video today to not get involved up at these all-time highs, because that's where so many retail traders make the mistake. They go chasing the tops, and this is exactly what the big hedge funds, the banks, the experienced traders want. You know, they will have a market which works its way all the way up to the top, and then of course there'll be some sort of fundamental news which will try and make the market spike towards a record high. Meanwhile, you know, the smart investors, the smart money have already taken profits at a lower level. So the point I'm trying to make to you all today is to not go chasing the tops. I know it's very difficult at this moment in time to think that these markets could fall down towards the 200-day EMA, because they haven't. Well, this is NASDAQ100, but NASDAQ100 hasn't touched the 200-day EMA since the 8th of April 2020, and the S&P 500 hasn't touched the 200-day EMA since June 2020. But I will tell you now, they will eventually. And you know, the past 12 months have been fantastic, because as I just mentioned at the start of this video, the Fed has been injecting $120 billion into the financial market. So every dip that has occurred has just been bought up, but times are about to change. We are about to enter a tapering process, and technically speaking, what comes after the tapering process is that interest rates start to get hiked, and we can see that from the bond yield reactions during yesterday's trading session, which indicate that the first interest rate hike is expected to come in May 2020. And I'm just going to quickly zoom out to the end of 2017, going into 2018. If I take you over to the S&P 500 chart, I think I've already circled it. There we go. So this was the S&P 500 at the end of 2017 going into 2018. I did actually show you this on the chart a few episodes ago. This was where Donald Trump was elected president. The market had a fantastic rally towards the upside, and the 200-day EMA wasn't touched for pretty much 12 months. And then what happened? We had Janet Yellen, who was the Fed chairwoman at the time, announce that interest rates would be hiked for the first time in a decade, and that was due to the financial crisis. They were cut to an all-time low near 0%, and they stayed there for 10 years. And then once Janet Yellen announced that there was the potential of the interest rates being hiked, look what happened here in the S&P 500. We went all the way down to the 200-day EMA and touched and fell 11.85%, so pretty much 12% in a space of 4 days. Okay, I'm not saying that that's going to happen again, but what I am trying to warn you all about is that I do expect a significant amount of volatility in these markets. And don't forget, guys, we are a lot higher valued up at these all-time highs. We have rallied significantly. So again, even if we did fall to the 200-day EMA, we would have still rallied 94% off those March lows. So I thought I would just come on here today to try and you know, warn you guys not to be going chasing these tops, because I see it time and time again. You have the retail traders, you know, those who are new to trading, don't really understand the full, you know, the full picture, etc., and they'll try and chase these tops to try and, you know, gain 2%, but they don't realize that they're risking 5 to 10% drops, and they are coming. I will tell you that right now. It might not be this week, it might not be next week, it might not even be this month, but they are coming once that tapering process starts to begin and we edge closer and closer to May 2022, and there's just the word of interest rates starting to get hiked. That will make this market very, very scared. And as I just showed you on the weekly chart, right now we have rallied significantly over the past 18 months. Look how steep that incline is compared to you know, the past 2 decades since 1998. We haven't rallied this steeply in over 20, well, ever actually. But I'm going to wrap it up there. I thought I'll just come on here, as I just mentioned, to just kind of give you guys a heads up, especially to those who are new to trading, as I do not want you guys losing your precious money. And that is going to wrap it up for today's video. But just before I let you leave, I just want to quickly show you our brand new streaming service. We've recently launched this website that you can see in front of you. This is where we provide in-depth analysis videos as well as trading signals via our Telegram group chat. How it works is really simple. We have two subscription plans. First one is a monthly fee of $19.99, and the second plan is only $209.99 for a year's subscription. Once subscribed, you'll then have access to all of our in-depth analysis videos, as well as access to our private Telegram group chat. We cover various markets such as commodities, US stocks, indices, and cryptocurrencies. We also have a video category where we provide educational content so that you can improve your trading skills. If this sounds appealing to you, then you can find our website link in the description of this YouTube video at dailymarketmovements.com. If not, then I would just like to take this time to say thank you for watching today's YouTube video. Please give my channel a subscribe and give this video a thumbs up. Thank you very much, and I hope to see you again soon.